This is the Economy and Markets third quarter, hosted by Jay Diamond, and we're starting right now. I just want to take care of a quick housekeeping item or two before we get started. I do want to point out that on your screen you have a box where you can ask a question. We encourage you to type in any questions you may have during the presentation, and we will be able to view them here. We will do our best to address your questions either during the presentation or at the end. If time allows at the end, we will take questions from the audience. If we don't have time or you feel your question is not answered or you would like some more explanation, we encourage you to email Jay or your advisor at your convenience following today's webcast. Without further ado, I'd like to introduce our managing principal, Jay Diamond.
Thank you, Scott, and welcome everybody. And again, once again, sorry for that little technical difficulty. It's not my fault. I'm not the tech guy here, but these things happen. What we always attempt to do in terms of a fast explanation is we attempt to, for people that can't tune in live, we attempt to record this. And most of the time we're successful, and hopefully we will be this time too. But anyway, let me get started with some opening comments here. The reason why we do these things on a quarterly basis is we're trying to attempt to answer the question or shed light on what's going on with the economy, the markets, taxes, interest rates, inflation, unemployment, government debt, and spending. All these areas are of interest to us and possibly to you. And there's a few hot topics here, obviously, which we're definitely going to touch on today, of course. We do this because it gives us some insight as to how these areas might unfold. As always, in the form of a disclaimer, nothing is certain. I'll make certain statements in terms of what we expect. No guarantees, of course, but hopefully some educated knowledge will go a long way. We like to share with you what we're looking at, what the advisors here at Investmark are looking at, studying. This way we can better help you with your wealth management, your financial planning, and your investments, of course. I always also caution that, this is complex stuff. There's a fair amount of information here. Feel free to review it again on our website, assuming the recording is successful, or choose not to do it, to review it if you don't feel like it. But it gives you an appreciation of the complexity of all this and how we're attempting to take it all in and give you some guidance accordingly. So with that being said, let's talk about, and again, this is a focus on the third quarter, July, August, and September of this year, and of course a look ahead. But in terms of what went on that was material over the last couple of months, well, first of all, I want to just touch on, some of the language and terminology and topics. We've heard a lot about Fed tapering, and then when that happens, bond yields, interest rates are going to go up. So what were they talking about there? As you probably know, since we kind of went through the recession and the downturn, which we'll reflect on in a minute, 2008, the Fed has been putting money into the economy, has been trying to keep interest rates low, and they've been buying about $80 billion of bonds per month for quite some time now. And they had announced earlier this year that, hey, at some point we think we can kind of take our foot off the gas pedal here a little bit. And so we'll taper or lower the amount of bond purchases we'll make with the view of an improving economy, which we expect. And the Fed had announced that they expect that the GDP, the economy, gross domestic product, was expected to grow next year, 2014, between 3 and 3.5%, which really isn't too bad a rate of growth. Well, September was when it was expected the Fed would start to lower the amount of bonds that they buy, start to taper. And it didn't happen as anticipated. They basically said they weren't going to do it right at that moment in September, but that they could start this tapering anytime. But when it does happen, what is expected is that they will lower the amount of their purchases maybe by 10 or 15 billion per month. So on an $80 billion purchase plan, it's not a lot of tapering. Of course, the markets hang on every little thing, and the markets did react to that. And the Fed has also forecasted that the decline in unemployment, which is now, as we'll talk about, kind of, in the sevens, they expect it to hit 6.5 to 6.8 by the end of 2014. And that they're specifically keeping the short-term rates low in targeting a 6.5% unemployment rate. So that's the point at which they'll say, okay, we can start to let interest rates rise. That being said, most Fed officials actually don't expect an increase in short-term rates probably until 2015. So we're not really expecting big changes in interest rates really anytime soon. And they did say right along that they're going to continue their purchase of agency mortgage-backed securities and long-term treasuries. That's the 80 to 85 billion or so that they have been purchasing. And this wouldn't be, again, just to reiterate, it wouldn't be a slam the door on the amount of stimulation to the economy and attempt to keep interest rates low. It would be done in kind of measured and gradual steps. Now, keep in mind something. People say the initial reaction was, oh no, if the Fed takes their foot off the gas pedal, that's a terrible thing. When the Fed does reduce the stimulus to the economy, again, it's because the economy is doing better on its own and it doesn't need the stimulus. So it shouldn't be a panic situation. It's probably really good news. But people say, well, if that's the case, when the Fed does start to lower their demand, then the interest rates are going to go up, and that's bad for bonds. Well, there's a lot of headwinds to bond yields, interest rates zooming up. We're still kind of in a deficient demand, kind of on a worldwide basis, with employment levels on the kind of still somewhat on the depressed side. Things are not booming, everywhere. So there's not that much in the way of inflation pressures and higher interest rates. We're still, in the U.S., working off a deleveraging cycle, which started after we had too much leverage in the economy, which was the reason why we had this big recession in 2008. So especially the private sectors and individuals have deleveraged, less debt, and especially on the local level, state and local, a little bit less in the way of public debt. Of course, we'll talk about the federal government in a minute. And then savings is going to be somewhat challenged as healthcare and entitlement costs will continue to weigh on growth. So there aren't all these items that are going to have the economy kind of booming and zooming, and we're going to have inflation. All that is going to be very much more gradual than maybe most people think. And some other reasons here as well, just kind of listed on the slide. So we don't expect anything dramatic to happen overnight. Okay, let's get to the latest hot topics, which is really what we're talking about and seeing in the news pretty much on a daily basis now. We've got two issues. One is this government shutdown, which went into effect October 1st, basically 2 weeks ago today. And so why did the government have to go through a shutdown? And the reason is because a new budget for the fiscal year October 1st to September 30th of next year has not been decided, has not been passed. So that we don't really have a budget. And so that's why the government had to start shutting down certain aspects of it. Now, as you might have heard, this is not the first time this has happened. We've had government shutdowns in one form or another. This 18 times, including this one. The last time we had one was in '95. It got worked out, but it lasted 3 weeks. We're at the 2-week point right now. And even though this is underway, most essential government services are still functioning. You've heard about, state parks and things of that nature that have been shut down. And it's been kind of picked and chosen. But the most essential government services are still functioning under this government shutdown. Things like Social Security checks will continue to go out, Medicaid, Medicare. The very latest item, which is actually a slightly bigger deal than the government shutdown, is this debt ceiling. And the debt ceiling is effectively the legal amount of debt that the government can have outstanding, which right now is about $17 trillion. And we'll talk more about that. This needs to be raised by approximately October 17th to avoid default. And that's not an exact date, it's an approximation. That's the point at which technically we do run out of funds, so to speak, and we have to raise this legal debt limit. That being said, even if we went a little bit past October 17th, everything does not come to kind of a grinding halt. The government has cash on hand. They do have spending and revenue flexibility, and they would probably be able to make it through the end of the month without incurring payments being in arrears. And again, that word default, okay, it means on all the Treasury bonds, default means either not paying your interest on time or not paying your principal when it comes due. All the debt doesn't come due October 17th, and all interest payments are not due on October 17th. But that's the point at which we effectively have hit that debt limit, and we need to raise it. And as we'll talk about, that 99.999% that is going to happen. And it's probably going to happen. Today is the 15th, so it is probably going to happen, and almost certainly is going to happen within the next 48 hours. What appears to be, from what I read, kind of the tentative plan is that we'll have something that will keep the government open immediately and probably through about January 15th, and also raise the debt ceiling until around February 7th. So it kind of buys some time to kind of get into some of the details and come to some compromises, hopefully, and some agreement. And to have a complete budget deal done by mid-December. Those are the things that are kind of being kicked around, at least as of today. So it's a disconcerting thing, but in some way, shape, and form, we have been there before, and we'll probably be there again. And it's painful, and it's noise, and it's a distraction. It generally does not change the long-term nature of what we're trying to do for you. So let's just kind of put that behind us for now, because we're very confident that that will, in fact, be worked out. May not be to everyone's liking, but that will be somewhat put to bed. So let's move ahead here. Oh, I'm just trying to. Okay, thank you, Scott. A little assistance there. And let's look at what we typically look at. Let's see how the market's been doing, because none of this is a surprise. So first of all, in the third quarter, I'll just kind of highlight that right there. In fact, the markets is measured by the S&P 500, which is the metric that we're going to use, not the Dow Jones Industrial Average, but the 500 largest stocks, was actually up about 5% in the third quarter alone. That's a good quarterly return, and we've actually had pretty good year-to-date returns as well, as we can see from some of these charts here, or the green line on the bottom. The markets are actually up about, this S&P 500, about 19% year-to-date. And 5% again, as I said, in the third quarter. That's pretty good. It's actually way above average. So that's not bad. We'll talk about kind of where we're at. And there's been a lot of talk about the markets are at all-time highs, and we're going to talk about that. But as I have here on the bottom, we're really just moderately higher than the peak from 6 years ago in 2007, before the crash that we had seen. We're about 22% ahead of that, but that's over 6 years. On the other hand, we're way up, from that trough, which people thought was the end of the world, and we knew wasn't. And we can see the markets have recovered quite nicely since then. So, the question is, are the markets high, and what's the pattern? And I have shown this before, but I always think it's worth revisiting. This is what the markets have done, the stock market, over the last 15 years, and you kind of see a zigzag pattern here, up, down, up, down, up, down type of thing. The big decline that we had in 2000 to 2002 was referred to as the tech wreck, and the one that we just witnessed not too long ago was referred to as the housing and mortgage meltdown. So again, we're kind of back up slightly above the prior two peaks from 2000 and 2007. I just want to highlight here where we're at. So you can see the number on the top. We're at these moderately higher levels. The S&P at the end of September was 1682. It's about 1700 right now, so it's basically the same. And yes, that's higher than it was, but not significantly higher than the prior two peaks. But more important than that isn't the absolute number itself, is the valuation. Are the markets expensive? And that the key metric there is something called the PE, price earnings ratio, where we're looking at what are people paying for a dollar of earnings. So if we go back to March 2000, we were paying $25 for a dollar of earnings generally, and now it's closer to 14. So the markets, at least on a historical basis, do not look expensive. Another metric is to compare stocks to bonds. And what we're pointing to here is that the actual dividend that comes off of stocks, dividend yield, is about a little over 2%. And right now, a 10-year Treasury bond would pay you 2.6. A little bit more, but remember, with a Treasury bond, in 10 years, you get your principal back, no more. Whereas with stocks, you have the opportunity to usually have a higher valuation, a higher price, I should say, 10 years hence. And the dividends have the opportunity to increase. So based on this metric, stocks really don't look expensive, and compared to bonds, they look like a better buy. Let's dig a little deeper here, and this is always worth doing this kind of third grade multiplication to get a sense of things. This is, on the bottom here, we have earnings. I'm just going to actually back up a little bit here. The earnings on the bottom show that the estimate for the earnings on the stock market is about $118 for a year. And so the way we determine whether the market's expensive or not is the math that I have here in this box on the bottom, $118 of earnings at an average PE for the market. Look at the upper left. We can see over the last 20 years, the average PE, although it's been higher and lower, is about, call it 15. And we're actually slightly below that now. So if markets were priced at the long-term average right now, with $118 of earnings, the market should be, quote unquote, about $1,770. Well, we're about $1,700. So looking at it strictly from a historical and mathematical standpoint, the markets do not appear to be expensive. And if you do the math and you kind of interpolate here, you say, well, the markets probably should be maybe in the 1770 or 1800 range. And we're below that. Point out the average PE. So that's how we kind of get to being able to make the statement that markets don't appear to be expensive. When we're talking about markets, we're talking about corporations and the stocks of corporations. And if we look at the health of corporations, in the upper right-hand side, we can see over the last, this chart goes back about almost 50 years, and it shows what the corporate earnings are in relation to the overall economy. So earnings are up in relation to the percentage of GDP. That's a good thing. And debt, the amount of leverage that these corporations have, is down compared to average. So corporate America, as you've probably heard this said, is actually in pretty good financial shape. They got their act together quite well in the last few years. And again, when we're buying stocks through mutual funds or directly, this is what we're buying. So corporate America looks good is a reasonable conclusion here, as I've said. Well, there's some other interesting things to look at. You know, we alluded to, well, you know, but interest rates are probably going to rise. We agree with that. So what does that mean? I mean, obviously, most of you know that when interest rates rise, generally bond values decline. But what about stocks? So here's a chart that has looked at, you know, the correlation between rising rates and what happens to the stock market. And what we're observing here is that when the Treasury yield is below 5%, and it's below 5% by far now, it's, as we said, it's about 2.6, that rising rates are generally associated with rising stock prices. Most of those dots, you can see where that dotted line is, have been on the positive side. There's a positive correlation there when we're at you know, the levels that we're at right now. And so if rates do rise from here, which we expect, that generally, based on history, should be positive for stocks. And that little dotted line is kind of where we are. That black dotted line, that's kind of about 2.6. And in history, we've had a nice positive correlation between rates rising and stocks actually going up. So let's again dig a little bit and take a look at, corporate America. Corporations have cash. The chart, to the right, you can see that corporations have a decent amount of cash as compared to what else is on their balance sheet, which means they can do things with it. Also, capital expenditures, which is usually what they do with cash, are pretty strong. That's what's being exhibited here. And it looks like we could have even more merger and acquisitions, and we have had some, and we could have more. That's generally bullish for stocks. Stocks typically, or in many cases, pay dividends, and the lower left-hand side is showing us that the payout ratio is about 30%. It has been higher, so corporations have the capacity to raise their dividends. They can pay out more of what they earn. And that's what we're taking a look at here on the right. Dividends per share in the gray have kind of gone up into the right, and so that's been a good thing. And share buybacks, there could even be more of those coming. So that's what corporations can do. They can raise their dividends, they can buy back their own shares, or they can put money into capital expenditures. Another interesting chart here, again, just to kind of harp on the PE. The PE is like 14 or 15. Usually when the PE is in that range, then the subsequent 5-year period, most of the dots here that were being highlighted, the observations are that the markets have actually done pretty darn well from this PE level. There aren't too many that have been kind of flat or negative. Most of them are actually quite good. So again, studying history is giving us some relatively positive indications. Well, we do talk about GDP, so I just want to revisit this chart on the right. First of all, GDP, right now, the latest reading, second quarter, we don't have the third quarter yet, is 2.5. Not bad, not outstanding, certainly not negative, not even close to negative. Kind of a slow growth type environment that we're in now. And again, the Fed expects that to be between 3 and 3.5 for all of 2014, and probably 2.5 on an annual basis for this year is kind of what we expect. Now, the biggest piece on the right of GDP, what makes up the economy, is consumption. And if you recall from the last time we did this, consumption was about 70% of GDP, and now it's about 68.6. So it's down a bit, but consumption is still dominant. People's spending, government spending is a big part of it. Housing's actually not as big a part of it as you might think, although it's still important. So just an observation there. Okay, well, bear with us here. Scott is, okay. He's just trying to do some things on my screen and try to make some improvements, I guess, to the audio. We're getting some. Okay. Well, we're gonna continue on here. Hopefully, you can hear me okay. So to continue on here. Thanks, Scott. Other elements that we take a look at in the economy, things that people can relate to. We've got car sales and light vehicle sales, which had been depressed, are now kind of back to their average. The average car is about 11 years old on the road, and we are seeing the automakers actually start to do pretty well, especially Ford for that matter. In terms of housing starts, when new houses are built, that does have a stimulative effect on the economy, especially in terms of jobs. The reason why housing starts had fallen off is because we had too many houses on the market. But as you can see in that lower left-hand box, we are starting to trend up in terms of housing starts. So that's a positive item. Capital goods, as I alluded to before, corporations are starting to put money into plant and equipment. That has come back pretty nicely. Talk about housing in and of itself. On the left-hand side, and I have shown this to folks in the past, as we can see here, on the left, that we really did have something that kind of looked like, that looks, trying to kind of get this cursor there. It really did look like, some sort of a bubble in terms of house prices. In fact, I think everybody knows that housing prices were obviously inflated from '05, '06, '07. Came back a bit to reality, and right now we are getting, some decent improvement off those troughs. I have heard some talk and heard things on TV that we're starting to get into another housing bubble. I really don't think so. We're not coming close to the old high levels, so that might be regional in some particular places. Housing, looking in the upper right-hand corner, a couple of other things to observe here is that in the upper right-hand corner, it's actually cheaper to buy than it is to rent, the average mortgage payment versus the average rent. So why is that the case? Well, we still have pretty relatively low interest rates, not as low as we had, but still quite low. And prices of houses are still reasonable, compared to, way they had been 4 or 5 years ago. So that's driving the demand for purchases versus rents. And as I had alluded to before, we had way too many homes kind of sitting on the shelf in inventory, '06, '07, and we're working that off here. So again, as that gets worked off, housing starts start to come back. And that's in fact what's happening here. So it's good that we're working off the inventory and starting to build some new homes. In terms of the consumer, and I want to make a big distinction here between the consumer and the U.S. government, and we have talked about this in the past, but it pays to be reminded about this. Consumer balance sheets are your assets versus your liabilities. So on the left, this is what we own as a nation. We own houses, we own financial assets, we own pension funds, deposits in banks. We own $88 trillion worth of assets. What we owe, on the other hand, mostly in the form of mortgages, is about $13 trillion. Our balance sheets as a nation, as consumers, is actually pretty good. There's other metrics that kind of back that up. The amount of debt that we have collectively as individuals, I'm talking about, is reasonable, the upper right-hand side versus what it had been. It's moving in the right direction in terms of being a healthier balance sheet. And net worth has been increasing over the last few years. So again, consumer drives things, and most of the consumer metrics look pretty good. Okay, so where's the problem? And this is old news. This is the federal finances. This is the U.S. government. And let's take a look at their income statement, not so much their balance sheet. Over here on the left this was the 2013 budget that just ended, and we need a new one. But this is the way things totaled out. $3.5 trillion of spending on things like Social Security, Medicare, Medicaid, defense, etc. And income, which is basically taxes, revenues, however you want to label it, that come into the government in the form of income taxes, Social Security taxes, corporate taxes, etc., are less than what was spent, to the tune of the difference, borrowing, about $640 billion, which actually is less than it was a year ago. So in that respect, the gap has been started to be closed. Of course, $640 billion is still a pretty big gap. And so therefore, there's obviously a shortfall. Now, this isn't new news. If you look at this chart on the upper right, most years these bars go up. When the bars go up, we have a deficit, meaning that we spend more in a given year than what we take in income taxes. And the forecast is for us to continue to have deficits. That is not a balanced budget. And obviously this is a lot of what the talk is all about, and rightfully so. But in terms of the accumulated deficits, because if you have a deficit and you need to borrow, you're adding to your total debt. The forecast is for the level of debt in relation to GDP to actually be pretty flat. So why is that? That's probably better than it had been, as you can see. From 2006, 7, 8, 9, 10, the last 4 or 5 years, the amount of debt that we've accumulated has gone up dramatically. But we have had, in 2013, we did have increases in tax rates. So taxes are up. And the economy, as we talked about, is improving. So one of the ways to close this gap is to pay more in income taxes. You can either raise the rates or you can improve the level of economic activity that is taxed. So as the economy gets better, it improves the income side for the government. As the rates are higher, that also improves. And both things have gone up, economic activity and tax rates. So that's why, the forecast isn't quite as gloomy as it had been. Sometimes these numbers are just hard to get your head around, and so what we had done last time, we had stolen a chart here that I thought was pretty good that, essentially says if your budget resembled the U.S. government's, and we try to put this in terms of something people can relate to in terms of a U.S. household, what that would mean. And there's various levels here of household income. So I'm just going to highlight one. Let's say there's a household and it has approximately $100,000 of income between all working people in that household, yet they're spending about $144,000. So they're spending $40-some thousand more than what they're taking in. Obviously, that's not a healthy situation, and most families couldn't afford to operate that way for too long. But that's the reality of what is going on, at the federal level in terms of U.S. government spending. And the accumulated debt, to bring it down to a typical family type situation, would amount to about $600,000 of debt had this been going on at the family level for the length of time that it has. So that's a pretty high level of debt. So it just kind of puts things in a more understandable perspective. As we talked about, the Fed has got its eye on the unemployment rate, which has improved drastically from the 10% level we were at a few years back, but we're at 7.3, which is still higher than average unemployment rate. And again, the Fed's targeting this 6.5, which is closer to the average. However, in the last year, we're moving in the right direction. We've had about 52 million people hired. Of course, there's been layoffs. There's been people that have quit. But we've had about 2 million in net hires in the last year. And but the other thing that people talk about here is that there's less labor force participation. So there's less people that are actively looking for work. We've got net retirees, which is the amount of people retiring versus people joining the workforce. And there's people that have kind of thrown in the towel on trying to find the career of their dreams or get back to their career. So we've had less people participating. Just hold on one second, if you don't mind here. We're fooling with some of the settings in the audio. Bear with us 1 minute, please. Okay. Thanks for that little pause, Scott. Yeah, it's all right. Scott took over the computer here and had to make some adjustments. So, but we're also seeing some slight hourly earnings growth. So, some of the metrics on the employment side are moving in the right direction. I think it's interesting to observe something that's obvious, and that is the unemployment rate is really all over the place depending upon the level of education that one has. What we're seeing here on the left is that someone with less than a high school degree, the unemployment rate is not 7%. It's 11.3, as of a couple of months ago. Yet those with a college degree or greater, it's actually 3.5%, as it shows at the bottom of the chart there. So there's a huge difference based on education and the employment rate. And also in terms of earnings, Obviously, bachelor's degree and advanced degrees have much higher earnings rate than typical just high school grad type education levels. So I just want to point out that not all unemployment is created equal. In terms of inflation, consumer price index, prices going up, well, yeah, they always are, and in some areas it's more apparent than others. But the official number is that inflation's running at about 1.5%. And that is less than the long-term average, noticeably. The Fed usually likes that. So we're low versus history. Oil and energy is an important part of our economy, no question about it. But when we observe this, the takeaway here is that in terms of oil prices, which is kind of the gold line there, obviously we see the trend over the last 20 years is obviously up. But it's kind of flattened out. I mean, it's volatile. It bounces around, but it's been relatively, tame within the last couple of years. But on the other hand, what's kind of good here, a trend that's developing, is that we are starting to import less, in the way of, foreign oil as a percentage of GDP. So we are becoming more energy independent. The trend is for that to continue. Less energy imports. So that's positive for our economy. The reason for that, there's a couple of reasons for that are exhibited here, but natural gas, which is still relatively inexpensive, there's been new technology which has helped us in terms of developing what were kind of uneconomic ways to get natural gas and oil out of the ground. Technology is actually helping domestic energy production. There's a whole layer of shale gas that's becoming more easily obtained. And if you look at the natural gas prices in the U.S., let's call it $3 per what they call MCF, 1,000 cubic feet. Pretty much the same in Canada. But look overseas at UK, Germany, and Japan. These folks use a lot of natural gas as well. Look at the average prices there. So over the next 10 years or so, I think you're going to see us exporting liquid natural gas. And so that will be good for our economy, and we have a healthy supply of it. So that's a positive toward becoming energy independent. That's going to be a big trend that I think is a positive trend. In terms of, we like to look at and remind people of something that may not be as intuitive as you would expect. And that is, they're always doing surveys as how does the man on the street feel about things, or the woman on the street. And they're looking at consumer sentiment. And what's interesting here is when the sentiment is higher, subsequent returns in the markets have been modest or low. So when those little brown dots, which are kind of peaks in consumer sentiment, are measured, and then they look at, well, how did the market do after that? And we're seeing not that well. Whereas the orange dots are when consumer sentiment is low, and the subsequent returns on the markets are actually quite good. Right now, consumer sentiment is actually a little bit less than average. So that's a slight positive in terms of the short-term outlook for the stock market. Interest rates is interesting, to observe interest rates over the longer term. We went through a long period from the late 50s to the early 80s of rising interest rates. And since then, we've generally been in a period of falling interest rates, as you can see. In terms of the actual interest rates on the Treasury bond, as we already said, the 2.6% right now is, a relatively low compared to the 6% long-term average on Treasury bonds. So, yeah, you look at that and say, well, the rates got to go up. They got to go back toward the average, and that's probably that is probably true. Just another thing to kind of reinforce: stocks have actually outperformed bonds in rising interest rates environment. When we have these rising rates, we can see here. Let me just kind of fill in some of these things here. So, when we had this rising interest rate environment, and this is what we would expect, then if I look at that top number, the S&P 500 from the late 50s to the 80s, that rising interest rate, did pretty well, about 8.6% average, and bonds did about 3. And we would expect that because rising rates are not good for bonds. In a falling interest rate environment, which we've had, then stocks have done quite well, 11% since the 80s, and bonds have done pretty well, actually. Not quite as good as stocks, but have been pretty competitive. But again, we kind of just say, obviously bonds do better in falling interest rate environments, even close to stocks, but we do expect that rates will trend upward. Now, I don't want to, disparage all bond categories, and I'm not going to talk about all the different bond categories, but suffice it to say that not all bonds are created equal. Let's just pick one, one particular sector right now, and I'm just going to highlight emerging markets, which are up-and-coming markets, bonds, and let's see here. Just give me a second here. Okay. Scott's fiddling with my screen again. Okay. So on the emerging market debt side, I just want to, thank you, Scott. Picking one category. Emerging market bonds come from Latin America, Europe, Asia, and they're in the form of government bonds or corporate bonds. There are governments outside of our government. There are corporations outside of U.S. corporations, and they all issue bonds. And we're keenly aware of that. What we've seen a big trend toward improving credit quality of these emerging markets, and we'll talk about more specifically what we're talking about. So this is a category we generally like. There had been a lot of flows on the lower right-hand side into these, and then it kind of tapered off considerably, but we might see more flows back into this area because the quality is improving and the interest rates are better. Let's switch to stocks and see, not just in the U.S., but elsewhere how things did. As we already talked about, the U.S. markets were up about 5% in the third quarter. It's good. But Europe, and Asia and the Far East actually did a lot better in the third quarter. So, we were thinking those countries were kind of down and out because Europe had its own set of problems and still does. Yet the markets have actually done reasonably well, and actually pretty well over the last quarter. And they handily outperformed the U.S. market. Again, this is why we diversify. Emerging markets, which we generally like on the stock and on the bond side, actually did about as well as the U.S. market, but on a year-to-date basis, they're lagging, but seem to be coming back. So that's a category we have in almost everybody's portfolios and will continue to. And for these reasons, you cannot deny what's going on in the emerging markets versus the developed markets. The levels of growth in their economies it's just more. These are the emerging markets taken as a whole, and generally the economies are growing by about 4% instead of about 2% in the developed countries. And so we're talking about China, India, Korea, Brazil, as you can see across the top, versus the developed market economies where no matter which one you pick out or take them as a whole, economies are growing at half the rate. So we can't ignore that, and that's the reason why we like to have some emerging market exposure or developing markets, however you want to refer to it. And again, why? Again, economies are driven primarily by consumption. And we can see here that emerging markets are where consumption is coming from. So most of the consumption hadn't been from the emerging markets, and it's still not the majority, but look at how that's increasing as those populations, grow and as they adopt, more of a capitalist system and they evolve, basically. I just want to go back just to this chart here. Again, we look at the value of the U.S. market and the U.K. I'm on the upper right-hand side here, as compared to the GDP. And UK, US are kind of mature markets, but the value of the stock markets in Brazil and India and Mexico and China in relation to their economy is small. So the markets themselves have room to grow much in the same way that we did, over time. In terms of flows of dollars, so there's you can see since 2008 in the lower right-hand side here, people got scared, the markets went down, and what'd they do? They put money into bonds, okay? So much more money, blue line, has gone into bond funds than stock funds. I mean, it's just, there's no comparison. What's happening now on the right-hand side? Oh, wait a minute, we're seeing a change in the trend. We're seeing more money flow into stock funds than bond funds. Odds are this trend will stay as interest rates, do start to perk up, as we're alluding to. The emphasis is going to be a shift, even for kind of conservative investors, more towards stocks than bonds, most likely. And again, not all bonds are created equal, so we do not want to abandon all bond categories. Also like to remind everybody this kind of historical observation that returns in stocks come from two places. They come from capital appreciation, your stuff going up in value, or down, or depreciation. It doesn't always go up by any means. And dividends, the amount of earnings that companies choose to pay out. And dividends are important, and they're a growing component of returns. If I look across the top, the long-term average of the 9% overall return all the way to the right of markets, almost half of that has come from dividends. So the blue represents dividends, and we're starting to see, I think, more in the way of dividend payouts, as we talked about earlier. So dividend-paying stocks is a category we like. We even built a specialty portfolio around that some of you have. Again, just to harp on equity dividend payouts, yields as they're called. Generally, in most countries, the dividends that you get off their stocks are higher than their 10-year government bond. In the U.S., on the lower right, the brown bar, there are, as we've talked about already, the Treasury bond is a little bit higher, 2.6, than the 2.1 we get off of stocks. But again, with stocks, we also could have some of that gray bar up at the top, capital appreciation potential. But in other countries, you can actually get more just from the dividend than you get from their bonds, with the capital appreciation potential as well. And on the right-hand side, a category that we've always been comfortable with is real estate in the form of stocks, which is called a REIT, Real Estate Investment Trust, whether they're public or unlisted. We just think that's a good category to have as part of the portfolio. And the reason why we're attracted to it is generally the dividends that these REITs throw off. Their distribution rates are higher than government bonds. And actually, in every case here on the lower right, the actual dividend yield that these REITs pay is noticeably higher than the comparable government bond. So again, as people are looking for yield, interest rates stay low, money's got to go somewhere. Typically it has gone to bonds. It may not go to bonds quite as much as it has in the past, as we're kind of in a slightly rising interest rate scenario. Want to also highlight, and this is important to internalize, is that in the short term, on the left-hand side, markets, whether it's the stock market in green or the bond market in blue, you can get all sorts of variations in return in a one-year period. I mean, we've witnessed 51% up in stocks in a given year and decline of 37. So that's volatile. There's no other label that I could possibly put on it. True for bonds. But as you stretch out the observation period, a 5-year observation period, like 1970 to 75, 1982 to 87, and you look at them all together, you see that the worst 5-year period for stocks or bonds has been -2. Well, it's not great, but it's not horrendous. But look at the upside there of what we actually have had. That's on a per-year basis. And as you spread it out to a 10-year time frame, we've almost always had positive returns from stocks. And when you blend it with bonds, the brown 50-50 bar, that's a reasonable range. And as you get out to a 20-year observation, which applies to most of the folks on this call. I mean, if you're 80 years old, it's possible you could live to your late 90s and still need your money. So, if somebody's 80, it doesn't mean that their time frame is necessarily 1 year. But the observation here is actually quite good. We've always seen so far positive returns over a 20-year period. A low of 6 compounded and a high of 18. Diversification is, an overused word, but for good reason. We add more categories other than stocks and bonds, and you generally can get better returns with lower risk, lower standard deviation. So having different categories of stocks, emerging market stocks, yes, some bonds, yes, some commodities, yes, some REITs, will usually serve you well over time. The problem is that on the bottom here, and this is a remarkable observation, and I've shown it before, but over the last 20 years, left on their own, REITs have done very well. Gold's actually done pretty well. The S&P over 20 years has averaged 8, etc. But the average investor on the right has not done well, has averaged about 2%. And you say, well, that's impossible. If they're investing in all the bars in the gray, how can they do less than all those things? And the answer is bad timing, which is mostly emotionally driven, like saying now, hey, I don't know what's going on in Washington, maybe we should sell. Okay, well, and get back in when. So you're really talking about 2 timing decisions, and that's kind of been proven it can't be done very well. So what we're trying to do is we try to keep you from doing that, from reacting emotionally at the wrong time. That's part of what we're here for. You have to remember, though, that, despite average, as I underline here, intra-year drops of 14, average returns have been positive in 25 of 33 years. So there's 2 observations here. One is on a year-to-year basis, and this is the last 30 years, most years the stock market goes up. Most of those bars go up. With this year in green, no exception so far. But during the year, we tend to see some sort of a decline during that year. Almost every year, even the ones that are the most positive, has experienced declines within the year. That's the maroon or reddish numbers and dots there. So I wouldn't think that most people would realize that most years we see intra-year declines of 10%, 19%. This year we've seen a peak-to-trough decline of 6%. So when you say, hey, the markets are going down, I looked at my August statement and it went down, it's like, well, so? I mean, there's no conclusion there, because every year the markets have gone down at some point during the year. Don't get head faked out of the markets is kind of our little saying here. Don't run scared, because the results usually are pretty respectable. Another reason why we're moderately bullish, on the stock market is because, again, interest rates are low. One of the alternatives for savers has been, money in the bank. And, cash, as it's called, savings accounts, money markets, it pays very little. You can have $100,000 in 6-month CDs, and you're going to earn about $40 a month off $100,000. That's not that much. There generally is alternatives for medium to longer term money. And there's lots of cash on the sidelines that's recognizing this and has been, and it's starting to come into stocks and bonds, but probably mostly stocks, as we alluded to in some of the other slides. So that's generally the end of the prepared, observations in terms of the economy, the markets. Tried to touch on the shenanigans that are going on right now. It's disconcerting. We do think that it will be worked out. It always has. It has to be. We're not going to go into a default and stay there. We may go an hour or 2 or a day past that, but there are some extra dollars to tide us through, probably through the end of the month. There's no question that something will be put to bed on that. It won't be ideal because of all the things we talked about, but we're probably still one of the better fish in the pond on a worldwide basis. Remind you of some kind of commercial messages. Our approach with you is that we are independent folks. We're not owned by anybody. We focus on you as individuals, and we make you talk about what your goals are so we know what we're working toward. We feel we take a very logical approach to going about doing this for you. We try to cover all bases. We've put together this wealth management blueprint. We focus on retirement planning and insurance, educational planning, running your portfolio through capital management, estate planning, taxation in conjunction with your tax preparer. Here's our new version of that, where we try to focus on things that we're planning, how are we achieving those items, and then protecting against unforeseen catastrophes. So that's kind of a new version of our blueprint. These are all the things we try to focus on your behalf. We have a lot of things in the back room on the shelf that we can take off the shelf that's always changing to put together a very comprehensive portfolio that can be somewhat all-weather, especially taken over time, whether it's an institutional multi-manager core approach with SEI. We recently kind of increased our affiliation with DFA, and we have an index approach. People always love indexes, but this is kind of the thinking person's index. We've put together very income-oriented mutual fund portfolios, tactical and defensive portfolios, individual stock, as I alluded to. We have a nice portfolio that we've put together that's mostly individual stocks that pay respectable dividends and have increased those dividends over time. Direct investments that we do believe in real estate or energy or whatever the case may be as part of a portfolio, futures. So there's a lot of things to choose from. That's kind of our diversified approach. And again, on that word is kind of where we'll end. We can't pick and choose and have a crystal ball and know exactly what to do every given moment and every time. But as you can see, having this type of a longer-term diversified approach usually gets the job done. So with that, we want to thank you for taking the time. Thanks for bearing with us today. We really honestly did have some technical difficulties in this particular case. Hopefully this did get recorded and you can review it again or tell your friends and neighbors to tune into our website, which we always encourage you to do to get a feel for what's going on here behind the scenes. I think, Scott, since we kind of did go over the hour, it's like 7 after 5. I think unless there's anything pressing, if you have questions about anything we talked about, you want to talk about it more, feel free to give your advisor a call, send an email. We love talking about this stuff and getting the job done for you. And obviously stay tuned to what's going on in the markets and the economy. We certainly will. And we hope to talk to you soon. Take care and have a good night.